Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of LME 3-month nickel, zinc and tin.
LME 3-month nickel. In the middle of May, prices started breaking down. On the way lower, the market made a mid-June to mid-July bearish halfway hesitation, moving lower but not really fulfilling any of its potentials, as the market reached down to the very significant lows of late November 2023 plus January and February this year, down in the 15,840 zone. At this point, the market in late July cracked the downtrend that prices have been riding lower since mid-July. In many ways, this was not a surprise, not at all. It is at this point that I feel obliged to mention once again the big descending scallop pattern I had been going on about for months and what it may mean within the near-term universe. So, the key level, as I've already mentioned, are the lows at 15,840. A significant move below this, and by that I mean you would know it when you see it, a significant break below that level would give a potential for the descending scallop pattern on the downside in the 13,830 zone, which is not too far away from the potential below for the old bearish halfway hesitation seen over June and July. Thus, it all came down to what the market would do once prices reached the 15,840 zone. Well, first time around, in late July, prices chose to bounce back upwards, and during the start of August sustained the bounce, moving higher, slowly higher overall. However, over mid-August, prices had an issue with testing the June 2021 low at 17,095, and I suspect indirectly the flatlining gold long moving average overhead, currently at 17,315. Initially, I thought this might tie in with an idea I put forward 3 weeks ago of the action over late July to August possibly being a mini cup with handle pattern. I was not happy with this pattern idea, but I thought it was worthwhile mentioning it. In the end, the pattern evolved into a mid-July to early September ascending wedge pattern, highlighted in dark blue on my daily chart. I'd even laid out potential targets topside for the original cup with handle pattern of a primary target X in the 17,200 area and a secondary, harder to reach target X1 up in the 17,470 area. These targets are now defunct and I'll retire them after this commentary. Early last week, prices broke down through the now ascending wedge pattern, easily reaching the primary target and not too far from the secondary target down at the July low at 15,600. Enough that I've chosen to not even designate it, as we are so close to it right now, today. So if the support down at 15,600 being so close, what happens if this gives way? Well, the next support is the November 2020 low at 14,935. However, the better support is between the congestion at 14,555 and the October 2020 low at 14,040, though in truth I'm not sure how good this may be given the ammunition we have overhead. I've also drawn a mid-May to late August bearish Andrews pitchfork to perhaps gauge the bearish angle of attack of the very recent market. Prices are currently trailing along a little under the upper tine, currently at 16,225. The one other thing I would like to mention is that we might just form a possible double bottom over July to date. It is way early, too early to really consider this, but keep it in the back of your mind in case the 15,600 July low holds prices and we see the start of a pullback up. LME 3-month zinc. This is a very busy and colourful chart. For that I apologise, but all these patterns do relate to what is going on right now. So let me explain. Prices peaked this year at the neckline of the September to December 2022 reverse head and shoulders pattern, currently at 31.41, with a horn top in late May. The market moved back down, rejected by this neckline, reaching the primary and secondary targets for the horn top, but the decline became hesitant in mid-June, especially when it tested the interesting support, currently at 28.24, of the dark blue broken, emphasize that, broken upper tine, the old May to August 2023 bullish shift pitchfork that had acted back then as an August 23 to April 24 upper bull channel line. I would normally have retired this broken pitchfork, but this pattern still resonates even today. Anyway, I said 13 weeks ago, and I quote, "This is the first decent support we have seen, though I would not be surprised if prices do move further down near the middle time, currently at 26.59, end of quote. Prices did drop down just below the middle time in early August, but this drop was not singular, rather it was part of a late July to date small reverse head and shoulders pattern. 2 weeks ago, we saw prices drive higher, not only over the neckline, currently at 2900, but also over the June 2021 low at 2810, the old dark blue upper time, the green short medium moving average, currently at 2806, the medium moving average, currently 2860, and also over the upper time of the late May to early July bearish shift pitchfork, which I only drew 4 weeks ago and have already retired. This also countered quite strongly July's monthly key reversal down. Consequently, I last week laid out some potential topside for the reverse head and shoulders pattern of a primary target X in the 3009 area and a secondary harder to reach target X1 in the 3087 area. What we had in a way to stop it was a congestion band between 2958 to 2965, containing the April 2019 high at 2959 and a 50% Fibonacci line, the big old 2008 to 2022 move at 2965, plus the green middle time, currently 2977, of the February to August bullish shift pitchfork, and then just over the 3000 level, the July high at 3022. These were all enough to turn prices lower, especially I suspect the green middle time, such that this week we are testing back down below the gold long moving average and the congestion generated during late July and August. The move has been enough that I will retire targets X and X1 after this commentary, as what initially looked like a reverse head and shoulders pattern, usually seen as a bullish reversal pattern, has turned out to be the rarer bearish continuation pattern. I've also drawn a new late July, late August bearish Andrews pitchfork in hopes of showing the bearish angle of attack of this market, at least until prices try down to the dark blue middle time again. We are right now in between the overhead upper time, currently at 2864, and the middle time below, currently at 2603. Looking below, well, the gold long moving average, the dark blue middle time, and the green lower time. These are the three zones to watch out for in any effort to stop the flow lower. It is too early here to look for another pattern, especially a possible bullish one, but I have some ideas for the future. LME 3-month tin. My apologies for another colourful daily chart, but they all help me in interpreting the market. Over April and May, we saw the market from a double top Adam and Eve type, leading eventually to the creation over April to July of a triple top. It also clarified the April to July sideways triangle, which finally had a proper break lower late 8 weeks ago. The market followed on with a move down to the primary target, but not the secondary harder to reach target. Likewise, for the triple top, prices reached down to the primary target, but not the secondary harder to achieve target. On the way down, we saw congestion support between 28,835 to 29,005, containing the July 2011 high at 29,005, plus the important slowly rising long moving average, currently at 29,415. And the nearby neckline extension of the October 23 to January 2024 reverse head and shoulders bottom, that's currently at 28,000. And finally, the 50% Fibonacci line of the March 23 to April 24 move at 27,330. All these slowed, stopped, and at the start of August turned prices higher. In hindsight, you could also throw in the dark blue middle time, currently at 26,225, of the April to July bearish Andrews pitchfork as well, but I'd personally stick to the gold long moving average and the congestion zone. Since that push back up in late July, almost looking like a small double bottom, prices have risen and gotten stuck in what I can best describe as an accidental congestion area overhead, created by the medium moving average, currently at 32,145, the green short medium moving average, currently 31,715, the 50% Fibonacci line of the March 2020 to March 22 move at 31845, and the neckline of the thin and tall April based head and shoulders pattern. Yes, that one, the one I mentioned a lot back then, and that's currently at 31,795. I said 2 weeks ago, and I quote, "This accidental area is actually the gateway to a whole load of congestion overhead dating from early April until mid-July. I had doubts about whether the market had the ammunition or the inclination to take things higher, but higher we have moved, breaking up over all those previously mentioned resistances, turning them into supports, and notably over the dark blue upper time, currently at 31,305. End of quote. 3 weeks ago, I also pointed out how beyond these, and I quote, "We have little in the way until the previous all-time high in April 2011 at 33,610 and the 50% Fibonacci line of the March to October 2022 move at 34,175, the latter being a significant level." End of quote. All this looked good for a break higher, but the market was reading a different script, turning lower in late August and down through all those previously listed supports, such that we are now approaching and testing for a second week the July 23 high at 3205. To take this turn of events into account, I have drawn a bright red mid-July to late August bearish shift pitchfork. The market is at this moment in between the upper time above, currently at 32,620, and the middle time below, currently at 29,520. I've chosen the shallower bearish shift instead of the more usual and aggressive bearish Andrews pitchfork here, as I think it better matches in sympathy of the larger dark blue April to July bearish Andrews pitchfork that had, sort of, shown the area where support might come in during the turn of July into August. I said last week, and I quote, "I'm not in love with this pattern. I would morph it into the more acute bearish Andrews pitchfork in a heartbeat, or even retire it completely if another better pattern developed." End of quote. However, it so far has served its purpose in showing the very recent bearish angle of attack, but not to take away what may be a more acute bearish move. I've also now drawn this week in purple the bearish Andrews pitchfork to just show how the more acute bearish angle of this pattern lines up with the market. Right now, prices are just under the upper time, currently at 31,185.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.